Hello and welcome to Policy Bazaar. I'm Arjun Bhagat. Now, the French poet Victor Hugo famously said, 40 is the old age of youth, while 50 the youth of old age. Financial and insurance planning for the 40 and 50-year-olds can be tricky. If you're in this age group, you may have taken care of many of your responsibilities, but you may still be worried about how to provide adequately once you have retired. So it's important to revisit and review your investment portfolios. To help us understand the best way forward, we've got with us Yashish Dhaya, the CEO of PolicyBazaar and also its founder. Welcome to the show, Yashish. You know, a very, very important topic. As you enter your 50s, is it time to review your investments, your insurance policies, and how should one go about that?
See, broadly thinking about it, 50s is that stage where your children would have undertaken some of their college, approximately that stage when the children would have gone to college. Some of the cost of college would have been taken care of. Some of those costs which you have had from a family perspective are somewhat behind you. Some may be very imminent in the next couple of years, but broadly what you're looking forward to from here onwards is a lower cost lifestyle with the two of you, hopefully the spouse and maybe some dependent parents, but a simpler lifestyle moving forward. And it's a great time to start thinking because you've got about 10-15 years to go for most people before they enter the retirement stage, after which external income, specifically if you're in the working group, there's a possibility that won't be there, and hence internal fund accruals will have to support that time frame. So if it hasn't been planned until then, it should certainly be very strongly focused upon, and the primary focus remains one of pension, and specifically a lasting pension beyond either spouse. So if the primary earner expires, the counterpart, the spouse, may survive another 10 years, 15 years, and in that time frame they need to be supported. So specifically, single pensions do need to move to dual pensions.
So what I hear you saying is that insurance, it doesn't mean the relevance of insurance comes down just because you've entered your 50s. And also, talk a little bit about term insurance plans when you're in your 50s.
I think when you're in your 50s, the term insurance plan becomes a little less relevant. The reason it becomes a little less relevant is because you're not at a stage where your children's education is going to get jeopardized, etc. And pensions become a little more important, but that does not mean that the economic value of the individual who is still earning. See, many people will be in the prime of their earning years at this stage. They'll be probably at the highest salaries they've ever earned. They will most likely be the last 15 years of your working life are the ones where you make the most amount of money for most people. So it is not a stage where you need to not think about term. But your term cover can start reducing, and your focus on term can start reducing, and your focus towards pension can start increasing. So, if you just look at a life stage, as you started out, your focus was on health. As one moves into the family life stage, your focus becomes term and health. And as you move in the older age, the focus becomes health and pension. Term starts to take a back seat, although it is still quite relevant.
So if someone decides to buy, say, a life cover or an insurance policy in their 50s, it doesn't make sense for them. What would it cost? And, and what are some of the best plans that they can go in for?
See, today the good news is life cover is available up to 75. So a 50-year-old can easily buy a 25-year-old life cover. We don't advise it because there is no point taking a life cover beyond. See, insurance should never be seen as a means to make money. But if you have not done your pension planning and there's a single pension plan and you don't have a dual pension plan, then taking a cover up to 75 is not a bad idea. Specifically because in case the primary earner expires, likelihood is that one of the people will expire before the other one. And the other person on average lives about 10-15 years, maybe 5 to 15 years after the first one has gone. And in that stage, the person has to be financially independent and financially secure. That can either happen through a dual pension or through a term policy. Now, up to 75 years, if you have a term plan, that can help. If you bought a whole life plan in your early days, that can help. So there are many ways in which you can create that basic support so that your partner who's kind of been with you for the last 40, 30 years of your life is not left in a difficult situation in the last 10, 15 years of their life.
Right. So you talked a little bit about term insurance plans. Now,
Yes.
As you go forward or you grow older, the costs of term insurance plans increase. Now, does it make sense to buy a reducing term insurance plan in the 50s?
See, there are not many reducing term plans available. And those that are available are unfortunately more expensive than the ones which are available as flat term plans. So if you bought a 50 lakh rupee reducing term plan today, unfortunately it seems to be more expensive than a 50 lakh rupee straight line term plan. Now that is odd as in a market that shouldn't be happening, but that is the reality, right? So in that case, it makes no sense taking, so I would, from a theoretical perspective, say yes, you should have a reducing term plan. From a practical perspective, just go for the flat payout plan because that is actually cheaper than the reducing term plan. So, take the advantage of the market situation while it is there.
Right. So another issue which is very important for everybody in their 50s, 40s is health insurance. Now, suppose a person or a couple hasn't really, taken a good health insurance plan. Does it make sense to do so when you're in the 50s?
Please do so ASAP. Without a single day's delay, because
but there will be costs. It is more costly.
There may or may not be cost depending on your health. So see, if your health is in prime condition still, and you're lucky to have that situation, in that case, you'll just go through a medical and you will get exactly the same cost as somebody who's had a health insurance for the last 25 years. So you will have no negative impact of not having had a health cover for the last 15 years or 20 years or whatever. However, if unfortunately you developed any of the pre-existing diseases or whatever, then the insurance companies will start shunning you. And your cost will go up, some will refuse you cover, it'll get more and more difficult, you will get into co-pay situations. So the point is, take it before the disease hits, and if the disease has hit, just take whatever you can. Health cover over age gets more and more difficult to get, and I'm not saying it gets more expensive in the sense, as I said, if you did not have a cover, but you are still fit, you will get pretty much the same cost as somebody who's had the cover for the last 15 years. Only thing is, some of the exclusions, which are 2-3 years or 4 years, will apply to you, which would not apply to somebody who's had the plan from before. But that's not a major event.
Right. So in the checklist, what does one need to look out for when buying a health insurance cover in the 50s?
When you're looking at a health insurance cover, what you've got to look at is, see, you're in your 50s, the chances are you are going to use this facility. So obviously take something which does not have too many caps. So, room rent caps, exclusions, look at all of that. If you can get a critical illness cover, please take it. Today, all plans have, they cannot cancel the plan based on age. So they all have automatic renewability for life. So that is a positive for you. Look at a plan that also takes care of, pre-hospitalization and post-hospitalization because as we get older, we do need that support. So I think these are the things you would, and look at the network hospital. So you would have pretty much at that age, you start settling down, so you know where you're going to settle down. So look at the hospitals around you and see which insurance companies have them in their network list. And if they have them in your network list, please, go for, so network list, inclusions, exclusions, any sublimits, and essentially a critical illness cover if you can get it. And how much cover can you get? Please try and take a little more cover than you may believe you need, because with inflation you will require it, and as you get a little older, companies are unlikely to give it to you to increase your sum assured as you get older. So you don't want to find yourself complaining 10 years later that, hey, medical costs have gone up, now I want to increase my cover and the insurance company is not increasing it. Take it from the word go.
Right, Yashish, now let's look at an overview of some of the investments. Different instruments are there, different plans are there. If someone wants to invest in their 50s, what should that portfolio look like?
See, in the 50s, your risk appetite needs to go down, because you can take risk when you've got time, but in the 50s with 15 years to retirement and most likely income stopping after retirement, you've got to take lower risks. So some of the fixed plans of insurance start to work. But let's look at the entire checklist. So you've got stocks, you've got mutual funds, you've got ULIPs, you've got PPFs, you've got in the mutual funds, you've got your systematic investment plans, your SIPs. So you've got real estate. You've got lots of options out there, and having a balanced portfolio makes sense. But I would also suggest plan something from a pension perspective. Go either for a fixed deposit or a 10-year fixed deposit, etc., which can become a lump sum and you can convert it into an annuity, but you won't get the tax benefit on that when you take your money back. The better option is perhaps going for an insurance plan, which is about 15 to 20 years long, which creates a lump sum for you and maybe some regular payout as well. There are quite a few plans which give you about 5.5% to 6% returns. Remember, FDs do not give you that return over a longer than 10-year period of time. Plus, the 5.5% to 6% is tax-free. So when you kind of adjust it back for tax, it comes to pretty much what an FD is giving you. But over a 15 to 20-year period, that can become quite strong. So HDFC, ICICI, Reliance, some of these companies, Birla Sun Life, they've got some plans which can give you about 5.5% returns, tax-free, and those can make some sense over a long period of time. And you create a lump sum which you can convert it into an annuity and hence create a pension policy for yourself.
Right, Yashish, it's time for a short break. When we come back, we're going to be taking your questions, but you can also write to us at ask.policybazaar.com or tweet us at policybazaar_in, and we'll see you shortly after this break. Keep watching. Welcome back to Policy Bazaar. I'm Arjun Bhagat, and Yashish Dhaya is with us answering your questions. Joseph Sinha writes to us from Orissa. He says, my daughter, who has a learner's license, had an accident recently wherein she drove into a small shop. I want to know that since she's a minor, will the insurance company compensate the shop owner? How does that work?
So a learner's license, if you have a learner's license, so there's a difference between saying she's a learner and she has a learner's license, okay? So if she has a learner's license and somebody with a driving license was sitting next to her, so a learner cannot drive on their own. A learner has to have a big L sign on there. So there's a few things a learner needs to have. So as long as she was driving in a legal manner, the insurance is valid. And the third party insurance, because she's caused damage to the third party damage can be paid for. It's a long process. Third-party claims are, quite prolonged. There will be a tribunal. They will decide how much they want to pay to the shopkeeper. The shopkeeper may not be happy with what they get, or may be happy with what they get. So it's a long, complex process, and it can happen. However, the important thing is, if she was a learner without a learner's license, there's going to be a problem. If she was a learner without a driver sitting next, with a full license sitting next to her, there's going to be a problem. And even if that was the case, if she did not have a big L symbol on her car, there's again going to be a problem. So, you may have to pay for this yourself. So please don't allow your kids who don't have a driving license to drive, because if they create some menace on the road, you will be liable to pay for it.
Bit of a tricky situation there. Well, we've got Anurag Bakshi from Indore. He says, I'm looking for an online term plan which covers me and my wife jointly in one policy. Something like a floater term policy. Is there such a plan in the market, he asks?
So there are dual term plans. There are dual pension plans, which pretty much mean a similar thing, if you think about it. But they are usually more expensive. It is almost cheaper to get two term plans than... So again, the same as I was saying earlier, theoretically, it would make sense to have a dual term plan. So, one person expires, or the other one expires, the other one gets the benefit. That's how a dual term plan works. And if the second person expires, the benefit goes to the nominee. However, practically those are much more expensive than taking two term plans as of today. So I would advise just go for two separate term plans, and that way both of you are covered, and in case anything happens to one, the other one gets the benefit, and if something happens to both, then the nominees get two benefits.
We've got Vaishnavi with us. Go ahead, Vaishnavi, with your question for Yashish.
Hello, I wanted to know if there is a cover available where cancellation of holiday booking can be insured. Also, under what circumstances will an insurance policy pay for cancellation?
Right, Yashish.
So basically, once you've started your travel, in case you cancel the policy, willingly, just for the heck of it, that is not covered by insurance. But many circumstances are covered by insurance, and every policy has their listings. But typically, more than a 7-hour delay or more than a 5-hour delay by international flights is payable if that's happened because of the airline's fault. And under certain circumstances, like where you just couldn't make it because there was a flood or there was some natural calamity, those situations would get covered. But if you on your own, or if you had a disease and you were under an emergency and you could not continue your travel, those kind of situations can be covered under travel insurance. However, you just decided that, hey, I'm not going to fly back today, I want to fly back after 2 weeks. No, that's not covered.
Right. We've got Yogesh from Bihar. He says, I'm 33 years old and I want to retire by 45. I want to go for a pension plan which can give me 30,000 per month. Please suggest a suitable pension plan, risk-free, and how much premium do I need to pay per annum, and for how many years?
So basic rule of thumb, if you want 30,000 rupees payout per month, if you look at it from an annuity perspective, as of today, you would need to collect a lump sum. So, your annual payout will be about 3.5 lakhs. That has to be about 6%. So you would need to collect about 50 lakh rupees as a corpus to build that kind of an annuity plan. And to build that 50 lakh corpus over a 15-year period, you would need to invest about 22,000 rupees if you do the calculation there. So whatever amount you want after 15 years, you got to pay about 2/3 of that today. And over 15 years at a 5.5% interest. So most of the fixed benefit plans, many of the fixed benefit plans, like some from HDFC, ICICI, Birla, as I mentioned earlier, and Reliance can provide you those benefits where after about 15 years, you will get whatever you've been investing for 15 years, you can get about 1.5 times that for a lifetime. More importantly, whenever the individual who has this plan expires, that same benefit can continue for the nominee, and they can also at the end of it get that 50 lakh rupee corpus back. So it's an annuity mechanism. The 50 lakh corpus is created. The 50 lakh corpus can pay roughly about 35,000 rupees on a monthly basis. And at the end of the period, that 50 lakh rupees can be redeemed by the nominee.
So would you like to retire by 45?
No, certainly not. I would like to keep working till I'm 65 or 70.
Right, there you go. All right, it's that's all the time that we have. Thanks, Yashish. But you can write your queries to ask.policybazaar.com, or you can tweet us at policybazaar_in. And we'll see you next time. Goodbye.